Hi, I'm John Stevenson, the Guaranteed Retirement Guy. Let's talk about annuities and mutual funds and the key differences and similarities. So if you have a mutual fund, you know that the fees, let's just start with the fees. The fees can be substantial, but most of the time they're not too bad. With annuities, the fees are a little bit higher, just depending on what you have in them. So if it's a variable annuity, you've got a ton of fees, like between 3 and 6%, what I've seen. If it's an indexed annuity, you can actually get one with zero fees, nothing. If it's a MYGA, there's zero fees. The only fees I guess you would have is if you had to surrender the policy. So that's a key difference is you can take the money out of a mutual fund and it is very liquid. Okay. It's much more liquid, and not all mutual funds are as liquid as others, but they, I would say as a rule of thumb, are much more liquid than an annuity contract. Because most annuity contracts, you're limited to the free withdrawal amount, which a lot of times is only 10%. Okay. So that is a key difference. Now, another key difference, of course, is mutual funds can fluctuate quite a bit with market conditions, even if it's a bond fund. Okay, you can lose money. You can lose money there. You can lose money in stock, ETFs, whatever it is. Okay, they can have a mix of it, and they all serve different purposes. But really, the whole goal of a mutual fund is to provide diversification, to allow you to have diversification across different asset classes like stocks, bonds, ETFs. There's a lot of cool stuff you could do. There's funds that you can where they gather so many different types of assets, and it kind of spreads your risk out. But it also spreads your reward out too. So it's quite a bit different than just picking a stock. A stock, you can get a huge return and, of course, a huge loss on it as well. So with annuity contracts, of course, they're guaranteed. Okay, you're buying guarantees. You're buying a contract. And if it's a contract of income, then you're buying a whole lot of income. And if you want to book a call to talk about that, I'd be happy to show you all the top annuities. There's actually a link below this video. Go straight to my calendar. But with mutual funds, you have no such guarantee, okay? So definitely keep that in mind when you're investing in those. Another difference is mutual funds typically at the end of each year, unless they're in a qualified account, you have taxable earnings, okay? So remember that. There are taxable earnings there versus an annuity, even if it's a non-qualified annuity, still is tax deferred, which is pretty cool. So you can put non-qualified money in there and it will stay tax deferred until you pull it out. I do like that. Now, of course, if the annuity is in an IRA, then IRA already provides tax deferred status. So if there's a mutual fund inside of an IRA, then they're both tax deferred. Okay, that would be where they are similar in nature is that fact. Okay. So mutual funds serve a purpose. They serve a purpose for growth, diversification, and also to have a little bit less of a loss if the market tanks, especially if you have some of your money in bonds. Okay, typically when the stock market dives, the bonds don't do as bad. It's not always the case, but rule of thumb is when you mix it up, you're not hurt as bad versus people in like small cap stocks where they're going to be hit hard when the market drops. With annuities though, the market drops, nothing happens with indexed annuities or MYGA annuities. With a variable annuity, yeah, you're going to go down and you're going to lose a lot. But with a MYGA, you're getting a straight fixed rate. Nothing's changing. Okay, if it's 5% every single year, that's exactly what you get. If the market goes up 20%, you're still getting 20%. That's the downside, right? But if the market goes down 20%, you're still getting 5%. Now with an index annuity, if the market goes up 20%, you might only get 12%. Okay, that's the downside. You're not getting as much as a mutual fund will give you. But at the same time, if the market goes down 20%, you don't lose a dime in the index annuity. You don't make anything either, so it's a zero. But it's a whole lot better having a zero, in my opinion, than having a 20% loss in there. Okay, that's not very fun to swallow. And a lot of you reach out to me and you've got money sitting in your account and you're like, all right, everything's going great. Let's purchase an annuity. And then a week later, you give me a call and say, actually, I've lost like 10%. Can we wait till the market goes back up? Let me just tell you, if you're going to buy an annuity, make sure you're ready to buy an annuity right then, okay? And I can't give you advice as far as liquidating your account, but typically when people buy annuities, they will usually put their positions in a cash position before they purchase an annuity to make sure that that money's there, okay? But, to each their own, right? So with annuities, you got to be prepared to put that money aside for that contract purchase.
for mutual funds, then that's a whole different story. You're gonna have a lot of growth, a lot of downside. You'll pay taxes if it's outside of a qualified account, but you'll also have the potential for growth and the diversification that it brings to people who are looking for a long-term investing plan. So I'm the guaranteed retirement guy. I focus on guarantees. I focus on income guarantees. I focus on growth guarantees. I focus on guaranteed, basically guarantees against any market loss, okay? So that's really, really important to me, that you should have some sort of your portfolio, some portion of it in a guaranteed account, okay? Such as an annuity, okay? Annuities provide guarantees, and they provide peace of mind so that when the market is tanking and your other investments are going south, you don't make the bad decision and pull out because you're emotional. We all are, and we'll pull out at the wrong time. And then it goes back up and we're all angry at ourselves, right? You know how that feels. Okay, well, with an annuity contract, if you got the income coming, you don't have to worry about it. Your lifestyle does not change. You're okay. You are at peace. If you want to go to Italy, you can still go to Italy. Okay, even if the market's tanking, you can still go to Italy because your income's coming in, and you know that this side, your risk side of your portfolio, is going to fluctuate, and that's okay because that's what risk does. It goes up and down. There is a risk to having your money in mutual funds. Okay, there just is. With annuity contract, you're looking for a guarantee. You're looking for peace of mind, okay? You're looking for something that is constant. And if that's something you want to talk about, book a call. There's a link below this video, and it goes straight to my calendar. And we can chat about whatever questions you have about annuities. If you're looking for income, if you're looking for growth and market protection, we can look at those as well. So again, thanks for watching. I hope you like, subscribe, share, and we'll see you in the next video.